Welcome to the Tax Talk podcast. Many Canadians own U.S. real estate, whether it be vacation homes, rental properties, or investments. But when it comes time to sell, cross-border tax issues can catch some sellers off guard. On this episode, I'm joined by Steven Flynn, a managing partner with Anderson, who specializes in cross-border tax matters. We'll unpack what Canadians need to know before selling U.S. property, including key tax pitfalls and planning opportunities. Steven, I just want to say thank you for taking some time out of your busy schedule to hop on the podcast with me today.
Hey, Jerry, great to meet you and happy to be part of it today.
Excellent. So today, the problem we're looking at, selling U.S. real property as a Canadian isn't as simple as selling just straight up in Canada. You may face U.S. holding with tax under the FIRPTA rules, exposure to capital gains in both countries, and risk of double taxation if you are not properly structuring and dealing with your tax affairs. So figured it would be great to bring Steven on here, as this is his specialty, and he can kind of provide some guidance to all the listeners out there on how to handle these transactions, as they seem to be occurring more and more as our economies become more and more integrated over the years. So first up, can you just give us a general overview of this FIRPTA withholding rules and some of the exceptions? My understanding, this is the Foreign Investment in Real Property Tax Act. If you could provide us with some guidance there, that would be great.
Sure. So the idea is this, is for a lot of Canadians who have real property in the United States, when you go to sell that property, because it's physical property located in the United States under the rules in the U.S. and under the guidance provided by the Canada-U.S. Income Tax Treaty, the United States gets first rights of taxation. And the challenge that any government's going to have is when they're trying to enforce tax law on people that don't live in the state or live in the country and who aren't taxpayers, is it's hard to enforce that on the seller to just have them comply with it. So what happens is that the buyer is forced to help the U.S. federal government and, in some jurisdictions, help the state government enforce that by withholding tax at source at closing. And that phrase you use is the abbreviation, the Foreign Income and Real Property Tax, Foreign Investment in Real Property Tax Act, or FIRPTA. That's a U.S. federal tax withholding that applies on closing. And the onus is put on the buyer to ask the questions and get the representation. And if you as a seller, if you're not a U.S. citizen and if you're not a U.S. resident, then anywhere from up to 15% of the gross purchase price is withheld at the time of closing.
Yeah, so that would definitely be a shock to some people if they're going to go sell that piece of U.S. real property, whether that's, your Arizona rental property or your vacation home, and then you're kind of saddled with this 15% on the gross, which is quite significant. So what is it that people should kind of keep in mind leading up to this? Because obviously you're going to have some implications as to the withholding itself. Is there, time periods in which this can be relieved? What is the relieving mechanism for getting that withholding back?
Well, and it's just that you use the phrase withholding, and that's just that. It's not a final tax, and it can be less than 15% depending on the value of the property and how the buyer is going to use it. It could be much less than that. It can also be higher if you're selling in states like California and Hawaii, where there's a state tax that's on top of that 15%. But it's a withholding. It's a temporary. It gets sent to the government, and it's a placeholder. It basically says as part of the seller, okay, we've got some of your money. That should compel you to file an income tax return with the federal government, file an income tax return with the state government, and now calculate what the actual tax is, not on the gross proceeds, because you're really taxed on the gain you make. And so what you're able to do is calculate what is the income tax rate on the gain. And so you take your proceeds and you reduce your proceeds by your sales commission. You take your adjusted cost basis, which is your purchase price, and maybe you made some improvements over time, and you figure out what you've actually made in U.S. dollars. That's what you're subject to tax on. And almost in all cases, that withholding tax is going to far exceed the actual tax you pay when you go to sell. And there's a reason for that. And it's basically the government's forcing people to file a tax return to reconcile the gain, to report the actual tax liability, and claim a refund for that federal and or state tax bill.
Right, and that makes sense. I mean, you've got the mechanism in place to withhold that, so some of that cash is going to stay in the states to ensure that the U.S. government has their kick at that can. And then your requirement to file those particular tax returns is going to be your mechanism to, again, like you say, calculate that capital gain, report it, and then presumably get some of that cash back as that withholding is going to exceed what your actual U.S. tax liability would be there. So beyond the state and the federal tax returns down in the states, what other obligations do individuals have for tax filings in order to kind of make this whole process play out then?
Sure, sure. And so that typical Canadian resident that owns the property in the U.S., even though the property's in the U.S., because they live in Canada and they're a resident of Canada for income tax purposes, Canada subjects them to tax on their worldwide income. That would include gains on the sale of U.S. real property. And that may sound like double taxation because the U.S., as we just said, is already taxing it. State of California, state of Hawaii, Arizona, they may tax it as well. But there's a mechanism under Canadian law that essentially recognizes the fact that if you pay $1 of tax to a foreign government, and not the withholding tax, but you calculate the actual tax liability on the gain, you can claim that as something called a foreign tax credit on your Canadian tax return. And so you're really getting a dollar for dollar reduction. So you're not really paying tax twice. You'll pay more tax to the U.S. government, maybe than in the total, but you'll get a dollar for dollar reduction in Canada. And so, the secret there is to make sure you're filing a U.S. tax return federally and state, calculating that tax liability, and it's that actual tax liability that is what's the foreign tax credit in Canada.
Gotcha. Off the top of your head, and I'm sure this is quite easy, what would then be the filing dates for those U.S. returns? Are they similar to the Canadian ones?
They're somewhat similar. The U.S. has a bit of a different process in that their filing deadlines are usually on the 15th of month.
Okay.
And so that could be either April 15th or June 15th, depending on that Canadian circumstances. And so it's not going to coincide with the Canadian filing deadline, which is generally April 30th. Right. Canadian filing could be June 15th, but they're about the same time. Some of the secrets on getting this done properly isn't so much the tax planning. We've talked a little bit about that, but it's actually that this is the mechanics of dealing with both governments. And for example, if you as a Canadian have never had any transactions with the U.S. at all, you may probably never have had filed a return and you don't have a taxpayer number. Well, you cannot use your social insurance number, your Canadian social insurance number, with the IRS or with the state government. You have to apply for their own number. And if you have a work visa to work in the U.S., that's typically what's called a Social Security number. But a lot of Canadians don't have a work visa, and they've maybe never lived or worked in the U.S., and they've never had something that identifies them. Well, you need to make an application to the Internal Revenue Service to get what's called an individual taxpayer identification number. And it's a different process, and you need to submit some documents. You have to get them certified. You have to have a reason to file for that. And so, you don't have to have that number when you close on a property. You can apply for that later. There is a bit of a challenge when you do it later because now you're into a bit of a manual process with the IRS. They get some tax money for you. They get a name, they get an address. They don't know how to put an identifying number. They send you letters. They sometimes have codes on them. And it's hard to match those two. And this is what gets people really frustrated. And when you read and talk to your neighbors and you read in Reddit and everything else, when people say, well, I'm waiting years to get my refund from the IRS, this is one of the reasons why. Is it's a very manual process with the IRS.
Gotcha. So I guess a good key takeaway would be is if you're planning to sell that piece of property, you should probably consult someone that deals with some U.S. tax matters and make sure you have some ducks in a row prior to maybe executing this. That way you can kind of navigate this process as efficiently as possible once you kind of follow through on it.
I agree. I say in general terms, when we have clients come to us with really no planning and no actions done, and they come to us and say, hey, I sold the property, I've had 15% withheld, we'll get the money back. The refund will be applied, it'll get back. It may take some time. And it could, realistically, it could take 2 years to get that back. When people come to us in advance and say, hey, I'm thinking of selling the property, what would I do? This is where we start to put some plans in place And again, I'm going to start with kind of the mechanics of it to say, okay, if we can make sure your U.S. number's in place or apply for that in advance, let's do that. If we then, help you with the closing documents, with the escrow agent. And in my experience, the escrow agency industry in the U.S. is a very high margin, high volume, low margin business. They're turning these things really quickly. They're air filled. And I've seen all sorts of mistakes that when money gets sent to the IRS or state government with wrong names or with mixed up buyers and sellers' names or with wrong amounts, it can delay things for months, if not years. And so I recommend to the sellers to have us get involved, spend that time at closing, working with the escrow agent, making sure that the tax documents are right. Because then, when we actually then go to file the returns the following spring or even sooner, then we can get that correct and make sure everything's lined up with the IRS and state government. There's other secrets we can try and do. We try and electronically file if we can. If we can get sellers to have bank accounts in the U.S., we can sometimes get direct deposits. When we've had success planning these things, months in advance of sale, we've seen our clients get tax refunds on filing these sale returns in a matter of 45 to 60 days as opposed to 2 or 3 years. And so it's what you want to invest up front to get this done right. And we've got lots of ideas that can help there.
Yeah, and I think that's a good point, and it goes with any professional, in my opinion. Why not do a bit of planning, outlay a couple dollars ahead of time? Like you said, if you can get that withholding back within 60 days as opposed to 2 to 3 years, I think that's money well spent ahead of time to put that plan in place for sure.
Yeah, it's the more you can prevent as opposed to react to the fact. I don't think I've never had a situation where we didn't get the refund back from a client, but
Right.
it's the amount of time you want to put in it to make sure it gets done right.
Gotcha. So can you comment then on the Canadian side? So we go through the process, we file the state return, the federal return. Now we're preparing that Canadian return. We are applying for that foreign tax credit. We make that claim, we apply that on the return, like you said, dollar for dollar. Then what happens a couple months after the fact, in my experience anyways, these foreign tax credits seem to be a highly audited area by CRA. You get a letter in the mail saying, we need to prove our claim in this regard. Is it my understanding that in a lot of cases, you need to have some sort of verification from the IRS to kind of prove that tax was in fact paid on the US side before the Canadian government's going to allow that foreign tax credit to go through?
Well, that's pretty much it. I mean, probably for the last 10 or 15 years, Canada Revenue's had an aggressive campaign on a number of different credits and deductions that could get claimed. And as you said, foreign tax credits seem to have an audit trail or an audit risk of greater than 50%. And I tell clients, like, if you're selling U.S. property and if you've never claimed a foreign tax credit before, you just have to count on the fact that you're going to get a letter in the mail that's going to audit that. They're not auditing the whole tax return. It's a very focused letter that says, we want you to verify that you paid tax to a foreign country. And it used to be decades ago, you could just provide a copy of the tax return and that was sufficient. Canada Revenue doesn't accept that anymore because those can be arranged, they can be done, they can be fake, all that stuff. And so they want proof that this return was not only filed, but assessed by the foreign government. And unlike Canada Revenue, where every time you file something, you get something called a notice of assessment that says, okay, we got it, we filed it, we accepted it, or we changed it. The IRS is the opposite. Unless you make a mistake on the return, no news is good news. You don't automatically get a letter from the IRS. And so it's difficult to prove that they've received and assessed the return. You have a methodology to do that. You can request a transcript from the IRS to do so. And then there's a process you go through and you request a transcript. But again, this is a lot like lining things up where you may find that you're filing your Canadian return in the spring, in April, like you normally do, and maybe you file your U.S. return shortly after that to get your refund because the U.S. return might not be due till June 15th. And then you find you get a letter from Canada Revenue in May and that says, well, we want proof. And now you get a bit of a gain because Canada Revenue is going to give you 30 days to respond. You haven't filed your U.S. return yet. The U.S., if you don't file electronically, they may take 6 months to assess the return. And now you're begging and pleading with Canada Revenue to hold on and wait until we get this return assessed. And they don't always do that. And so one of the solutions is to basically kind of go in the opposite direction and say, let's file the U.S. tax return as soon as we can. And if that's, January 15th or 31st or whatever it is, as soon as the forms are ready, let's file it. Let's get it done. Let's get it filed. For most people, they'll have all the information on that sale shortly after they sell it. You don't have to wait for tax slips in the U.S. You just have to calculate your gain. So let's get it filed. Let's get it filed early. Does two things. One, it gives the IRS a chance to assess the return and gives you a chance to get that transcript well before you file your Canadian return. It also could accelerate the time to get your refund. So we often work with our clients and say, let's get this done early in the year. If this is the only thing you have to file in the U.S., let's get it filed in January.
Gotcha. No, that makes sense. So I guess very generally speaking, would it be a reasonable planning point that if you were planning to sell that U.S. property, if you did it later in a calendar year and then got those documents into you earlier in the following calendar year, that would probably put you in the best possible position to kind of get things moving through the system as efficiently as possible?
Yeah, it's an interesting one. I mean, I would always hate to have the tax consequences dictate when you're to sell something, because whether you sell 1 month or another month, if you can get a different price or a higher price by doing something, that's what you should do.
Sure.
Even for some of our clients that sell in December, it doesn't take long if you're planning for this and you know this, and maybe you've held this property a dozen years, but as you're planning to sell, one of the things you're going to have to be doing is building up your cost basis and figuring out, okay, if I bought it 10 years ago, what did I pay for it? Where's that document? We put a new roof on it. We did the carpets. We got new appliances. We painted it. Where are those receipts? What are the amounts? What dates did we do that on? Like, you start to build that file up, and you can do that all in December and have it ready to go early in January. I mean, that's what the organized clients can do. And that way, if December 31st is the day that closes to get you the best price, go ahead and do that. If you can get a better price by waiting until January, that's fine. You'll probably wait maybe one more year to get your refund, because you can't really file tax returns in the year. I mean, the IRS has a process that if you overpay your tax in the year, you can get a reduction of the withholding. That process is cumbersome, expensive, and time consuming. And frankly, I don't think in my 3 decades doing this, I've ever had much success at it.
Okay.
Yes, you can get an early reduction of your withholding, but it might take the IRS a year to process that. So it's kind of a wasted effort.
Sure.
But if it's a big dollar sale and you do it in January and February, and if it makes sense to wait kind of 10 to 12 months to get it, that still may make sense. I'd never say no, but what I encourage clients to do is do the right thing from an investment perspective. Good proper planning and tax analysis can get the tax results for you.
And I would completely agree with that. I mean, more often than not, people come in and they're looking for a way to, save a buck of taxes. But, if you have to go through a whole bunch of hoops to get there, you got to outlay a bunch of cash just to save a couple bucks in tax. Does that really make sense? I think you got to look at the bigger picture and just ensure that what you're doing makes sense all across the board, as opposed to just planning to target this sale for a particular date and time to maybe speed up the refund, but then you're going to lose a bunch of dollars on the proceeds side of things as a result of that. So, no, that's a good point. Any, common mistakes that you see people making beyond what we've already addressed? I mean, the planning's obviously a big issue, ensuring that you get that ITIN number put together. Is there anything else that people need to kind of take into consideration that,
Yeah, from a Canadian side, I mean, one of the things you're doing is you've transacted in a property in a foreign currency, and so you've done it in U.S. dollars. And so one of the things that catches people from time to time is, they bought this property in 2010 or 2014 when the dollar was at par. Right. So they spent $500,000 in the property in U.S. dollars, and so your cost basis is also 500,000 Canadian because you bought it at par. When you sell today, and let's say it's $1.35. You'll have a gain in U.S. dollars. You'll also have a foreign exchange gain, and you have a 35% foreign exchange gain. That foreign exchange gain is taxable in Canada. Not taxable in the U.S. because there's no equivalent in the U.S. or there's no currency change in the U.S. But it's taxable in Canadian dollars, and that increases the gain significantly. And you need to be aware of that, and that's part of going through a robust calculation of your cost basis, figuring out when you spent money, when you made improvements, what you paid for it, what date you paid for it, what was the exchange rate then, and building that file up. I think the other thing is, for a lot of people, they rent the property out. And so that rental income is taxable in the U.S.,
Right.
taxable in Canada. If you haven't filed tax returns in the U.S. before, you probably have to consider doing that to report the income over the past years, because unlike Canada, in the U.S., you're forced to claim depreciation even if you lose money. And so if you rented the property out but didn't file returns, in theory, you're forced to depreciate the building every year. And that may create some rental losses for you. But if you don't file returns, you don't have those rental losses. And so you got to get the worst of both worlds. You get a lower cost basis, a higher gain in US dollars, but you don't have the losses to offset it. In Canada, if you're renting out the property, you have an obligation to disclose that rental activity on a separate form. It's called a T1135, and it's got some penalties if you don't do it on a timely basis. And so if you haven't done that, now in Canada, you might want to look at some amnesty programs Canada Revenue has to say, okay, well, I should have reported it. I didn't. I don't want to be paying a bunch of penalties. I can come forward on a voluntary basis if I qualify and get that fixed without penalties. Those are the things you want to try and do, before you notify Canada Revenue you've sold the property.
Right. Yeah, and I've kind of dealt in that voluntary disclosure program on a number of issues. And yeah, similar to some of the other issues in dealing with the IRS or the CRA, it is a long-standing process. You got to put together a whole package of documents to send into them. They will generally take a number of months before they reply back to you, and then they'll say, "Oh yeah, we've received it," and then as a result, we're going to process it at some point in time down the road. So, yeah, I mean, you got to be well prepared for those type of items and be willing to kind of put in the time to see them through for sure. Now, in regards to that cost base of that U.S. property, is there anything different that would be attributed in the States versus Canada, or is it kind of the same thing across the board? Obviously, you get your purchase price plus any additions that you would have. Is there any anomalies down in the States that people would need to take into consideration, or is there anything that you would advise someone to kind of put a system in place for tracking some of these things if they're thinking about buying a property now?
Well, yeah, I mean, I think that whether you own a property now or thinking of buying a property, a system to track is great advice. And that doesn't have to be a complex system. I mean, I've seen people use Quicken or QuickBooks or Simply Accounting. You can use a spreadsheet too, and just an online cloud storage to save all the receipts. It doesn't have to be robust, but you want to be tracking what you put into the property, what date you put in it, what the amount was to build up the cost basis. I think the biggest difference between the two countries is just probably the depreciation methods. And over a 10 or 15 or 20-year period, if someone's renting out that property, I would expect that the cost basis for U.S. purposes would be very different. It could be much lower than the cost basis for paying tax purposes because, general terms, if you rent out property, especially if it's a vacation property, you're probably breaking even at best. So you're not depreciating it from a Canadian tax perspective.
Right.
But you are from a U.S. perspective. And those losses will be deductible on sale. It's, those are some of the biggest nuances and differences between that.
Okay. So the depreciation is forced down in the States. If you are only reporting that rental income, or in this particular case, a loss, that would just accumulate over time. And then when you eventually sold it, then those losses would kind of apply when you recognize that final gain. Is that correct?
That's correct. So you'd be accumulating something called past activity losses or just, rental losses, whatever the nature of the property is. And, when you sell the asset that triggers those losses, then they would be deductible or claimable against the gain.
Excellent. No, that makes sense. I guess, is there any other, tips, advice that you could probably give to some people if they are in this particular situation, if they are having difficulties maybe getting that tax withholding recovered? Any final tips that you might have for clients out there?
Well, I think it's don't give up. I mean, we've seen lots of stories and situations, particularly coming out of the pandemic when the IRS, like Canada Revenue, like a lot of us worked remotely, and it really slowed down the process of processing mail and processing returns. And as much as they've generally caught up, it still takes a lot of time for the IRS to process these things, and any little mistake can set you back a couple of months. There are a number of ways if you're frustrated with the process with the IRS getting your refund, but there's a couple ways to do it. You can contact a firm like Anderson. We can help you walk you through the process. Often what we'll use is something called the Taxpayer Advocate Service in the U.S. That's a division of the IRS that's kind of separate that, doesn't cost anything, but they can have an avenue to kind of work through compliance issues or kind of filing issues with the IRS and, be on your side to fix that. So I've used them a number of times over the decades and with a lot of success. And so there's a number of ways to approach this. It's just not giving up. I mean, it can be frustrating to try and phone them, be on hold for hours and then get hung up on them. But there are a number of ways to do this. And Anderson could definitely help.
Perfect. And is it true, to my understanding, like any general person from Canada can phone into the CRA and ask tax questions or follow up on their account as they see fit? Is it slightly different if someone is trying to phone down into the States, talk to the IRS? Do you need to have some sort of certain authorization there to make that phone call to get some tax information? Can like the lay person do that, or do they need to kind of hire someone like Anderson to assist in that area?
If it's on their own account, they don't necessarily need power of attorney. They just need to prove they are. And so, the IRS will ask questions and ask you to prove, who you are, your address, your tax number, things like that. I mean, that can be done. It used to be decades ago that you actually couldn't phone their 1-800 numbers. And so that was a challenge. I think with all the different ways you can make phone calls now, I think that's been generally solved. It's a test of patience, though. But you can be on hold like Canada Revenue, you can be on hold for an hour. And, your challenge is you're dealing with, agents that can only take you so far.
Right.
And if you haven't worked with the IRS before, you can be frustrated with how Canada Revenue does things and processes things. The IRS's computer systems are much more antiquated. Some of them are kind of developed, written in the 1990s, and they're failing. And, Congress had, attempted to fund the IRS under the Biden regime,
right,
and pledged $80 billion to put into the IRS to modernize it, to hire, to do all these things. And very slowly, the Republicans under Trump have pulled pretty much all that funding back. So, there remains to be a lot of investment required in technology and systems with the IRS, and it just hasn't kept up and hasn't made. So that's another part of the challenge.
Okay. Yeah, it always baffles me to kind of see, when you have some of these discrepancies between the two countries, how some of the things that they have there as far as electronic and technology wise can be kind of further behind than we are. But I guess you kind of get up into a certain situation, through the bureaucratic process, and it probably becomes a little bit challenging to pivot and make some changes in that regard. So, no, that's good. So I guess in closing, just like I would probably always mention to clients, it always makes sense to have a plan in place in regards to these things. If you're coming into my office or you're talking to Steven, after the fact, obviously we can help you out and get you from point A to point B, get the file closed and get what needs to be done. But usually if you bring some of these things to us ahead of time, there's ways that we can kind of assist to make sure that if you're selling that piece of real property down in the States, you've got all the ducks in the row prior to pulling that trigger to try and make that process as easy as possible on yourself. So.
Excellent. Yeah, very well said, Jared.
Perfect. So again, if you are thinking about selling property down in the U.S., make sure, take some steps to think ahead and get some information and a plan in place ahead of time. One of the easiest ways to do that is to keep subscribed to this podcast, whether it's YouTube or Spotify. We'll be presenting more information in this regard in upcoming episodes. Beyond that, if you've got questions, feel free to leave those down in the comments on YouTube. I'm sure Steven would be happy to reach out to you and touch on any of these particular items that you have as far as the U.S. tax planning goes. And lastly, reach out to him directly. What is the best way for people to get a hold of you, Steven?
Sure, absolutely. You're welcome to contact me. Email is probably the best way to do that. And my email address is Steven, Steven, .Flynn. Flynn is spelled FLYNN at ca.anderson.com, and Anderson is spelled with all E's, so it's ANDERSEN. So that again is Steven.Flynn at ca.anderson.com.
Excellent. Yeah, and I'll definitely put all that information in the show notes. So if you've got any U.S. cross-border tax issues with respect to real property, feel free to reach out to Steven and get some of his expert opinions and advice on that particular matter for yourself. So once again, for the Tax Talk podcast, I'm Jared Pallon. Thanks again for listening. Take care, and we will talk again soon.